Assalamualaikum everyone. Today I will explain the investor objective based on this mind map. Investor objective are divided into two categories, which is personal and financial goals. So for personal goals, there are 5 points. First, insurance protection, which is help protect individual from unexpected financial risk. Second, providing a home where investors save to buy or maintain a house. Third, an emergency reserve, which prepare money for urgent situation. Fourth, education, which includes saving for school or higher study. And fifth, retirement, which focus on financial stability in future. For financial goals, there are also 5 points. First, safety of principal, which means protecting the original investment. Second, income assurance, where investor want steady earning like dividends or interest. Third, inflation protection, to ensure their money maintain its value. Fourth, liquidity, meaning investment can be turned into cash easily. And lastly, portfolio diversification, which reduce risk by spreading investment. In conclusion, investor objective guide people to choose the right investment decision.
Assalamualaikum, my name is Nur Shafika. So next, I'm gonna explain about the risk consideration. So as we know that in investing, the risk and return always go together. If the risk is low, then the return usually small. But if the risk is high, then the return can be bigger. So there are two main sources of risk, which systematic and unsystematic risk. We go for the systematic risk. It is the type of risk that we can avoid because it's external. We cannot control it. So there are three examples under this, which is inflation risk, market risk, and interest rate risk. So this type of risk affect everyone and not just one company. For the unsystematic risk, it is the opposite because it only affects one company and we can try to reduce and control the risk. So we have two examples from this, which is the business risk and the financial risk. So these problems are specific to only just one company.
There are several regulatory bodies in Malaysia. The first one is Bursa Malaysia. Established since 1930, Stock Exchange Malaysia and Singapore was separated into two, which is Kuala Lumpur Stock Exchange Berhad and Stock Exchange of Singapore after the elimination of currency interchangeability. In 2004, KLC changed the name to Bursa Malaysia. Bursa Malaysia provides a rule called Rule of Bursa Securities. They engage in every business, trading and settlement, becoming the market surveillance for securities market to ensure that transaction is in a good manner. The next one is Securities Commission Malaysia. Established at 1st of March 1993. They governs under the Securities Commission Act 1993. Their roles include supervised exchange, clearinghouse, central depositories, and regulates all matters regarding to capital market. Third one is stockbroking company, which is the intermediary in trading the equity. Investor will look for stockbroking company when they want to buy security. Investor will appoint broker from SBC to transact the stock. Most stockbroking company merge with merchant bank and discount house to be investment bank to relate in capital market. Investment bank act as a raise capital, trading securities, and manage corporate merger.
Investment alternative have two main categories. So I will explain about the first one, which is investment in financial assets. Financial assets have divided into securities, savings, unit trust, and also derivative securities. For securities, there are four items, which is treasury bills, common stocks, bonds, preferred stock. For treasury bills, treasury bills are short term to the government. They are very safe but give low interest. For common stock means you own a part of a company. They can give you high returns and the risk is very high. For bonds give a fixed interest. They are less risky than stock but don't protect against inflation. For preferred stock pay fixed dividend. They are safer than common stock but not as safe as bonds. For savings, they are divided into two, which is saving account and fixed deposit. For saving account, a saving account is very safe, but it gives a very low income. Money is easy to take out, so it needs discipline. For a fixed deposit means you keep a fixed amount in the bank for a fixed time. It gives higher interest than saving. So if you take the money out, you get no interest. The third one is unit trust. Unit trust is when many people pool their money together. Professional manager use this money to buy stocks, bonds, and other investments. It has lower risk because the money is spread out, but the value can still go up or down.
Lastly, investment in derivative securities, which is divided to two options and futures. There are three types of investment in real estate, which is real estate, collectible, and gold. Real estate refers to entities, as example, residential homes and lands. The advantage of real estate, which is safe and returns are secured, but the disadvantage of it involves large amount of money. Next is investment in collectible, which is investment made on items such as antiques and old stamps. The advantage of collectible is most items are protected by insurance, but it requires a large capital. Lastly, investment in gold. It have two types of investment in gold, which is direct and indirect. Direct, buy it outright,
as bullions and coins, indirect by gold certificate and gold mining stock. It has advantages which is psychological enjoyment, but there is no dividend or interest payments.